Conference, but the Citi India Conference kicks off tomorrow. You will hear a lot from the top guns at Citi over the next few days exclusively on this channel, but here's Aditya Narain, Managing Director and Head of India Research at Citi.
Market level, it has the teeth to be a little bit more painful, not necessarily vicious. Vicious would necessarily imply more short term. The clear risk is that structurally the dislocation that it causes in some of these economies could have the pain lingering on a little bit longer.
From what you've heard from Europe over the last few weeks, has that altered your view on the Indian market performance through 2010 in any significant way?
Not in any meaningful manner. In fact, what we've just done very recently is actually we've become much more constructive on the market, in part because the market has come off a reasonable amount. And in equal measure, our sense is that at the real economic level, there shouldn't be a difference. There shouldn't be too much of an impact. So between the two of those, our expectations is the economy will continue to do reasonably well. Valuations are, I wouldn't say necessarily attractive, but they're clearly not expensive. And between the two of them, there should effectively be upsides. What one needs to watch for is the fact that because a lot of the market movement in the last 6 months and over the last year or so has been driven by global money, the uncertainty that you have in the global markets could effectively change the flows of money. And in effect, there is the risk that a lot has come in, so a reasonable amount could go out. So over the short term, there could be a little bit of a risk benchmarked off what's happening in the global markets. But as far as the underlying is concerned, I don't see it making too much of an impact, and clearly not on the economy. So the bottom line is, at the end of the day, markets reflect the economy. And as long as the economy is not hurt too much, I think markets should at some point in time catch up and reflect reasonable value.
You said painful. I mean, what's the downside you think is possible because of any kind of liquidity contraction?
It's effectively, the pain will be out of money flowing out. So it'll be in terms of the market not effectively holding. I don't see the real impact being all that meaningful. But that's where there could be pain, because at the end of the day, this market through the year has prospered simply because there's been a lot of offshore money coming in.
But given that fundamentals are reasonably strong, you're saying, do you think we have a valuation float around 15,000 Sensex kind of levels, if it came to that?
My sense is that support would actually come in a little higher than as low as 15,000.
Okay. And if it happened, you would regard that as a buying opportunity?
Yeah, in our view, if you're not looking at very immediate returns and you're not necessarily trying to catch absolutely the bottom, this is about as good a time as any.
Can you just elaborate on the fact that your view is that Indian macros have actually improved over the last 4 or 6 weeks, even at a time when global macros might have worsened a bit?
Yeah, bottom line, and that's where we've really had a little bit of a shift in view, because all this while you've really had the economy or the real sector or the micro companies doing reasonably well. The headwinds were in the fact that inflation was rising, the risk that rates would rise and potentially relatively steeply. And the fact that the fiscal was just seeing its existing hole actually widen. I think all of that has actually seen a bit of a reversion. You've seen inflation tending to effectively peak out. We're not making a big call that will come off rapidly, but clearly the upward trajectory seems to have kind of bottomed out. It's the same with interest rate hikes. Between what's happening domestically and, more importantly, globally, our sense is rate hikes will still happen. It's just that they're going to be more measured. They're going to be pushed back a little bit. And in that sense, the market has probably already taken that in. And finally, the third element of the macro is really the fiscal deficit, where between meaningful successes on 3G and an easing in terms of oil prices, if things stay the way they are, you're actually not seeing any risk in terms of the number that was put out earlier in the year. So you combine the three of them, and it's not as if these have become tailwinds for the market, because the levels are still high. But I don't think there are headwinds any longer. And in some senses, I think that's what's changed. That's where there's been a delta in the market.
When we started the year, the interest rate factor was looked upon as one of the principal risks for the equity market. Now bond yields have cooled down from 8.25 to 7.5. Do you think now the view is that 125, 150 basis points of hike will get staggered over 2 years and not much will happen in 2010 any longer?
Our sense is we are actually not pulling back in terms of our expectations of hikes in the current year. We are still saying 75 bips that will happen over the course of the year. What we have said is into the next year, where we were anticipating about almost 100 bips in the first part of the year, that should actually get pulled back to about 50 bips.
You're talking about the first part of calendar 2011?
Calendar 2011. So in many ways, the pace of the increase into the next year has been pulled back and the extent has been pulled back. In the current year, we think there is normalization that has to happen, and that will actually continue irrespective of where bond yields actually end up.
So the equity market is priced that in?
Our sense is in reasonable measure. I would tend to believe it's not priced in 7.5%. If it had, the market would have been a little higher. But it has, at the policy rate level, kind of factored in that rates will go up, 75 bips as we have it.
Whatever liquidity risks we face now because of what's going on in the world, do you think there is any earnings risk at all over the next 3-4 quarters as you see it?
There is some earnings risk in that there is, a large part of earnings for the Indian companies comes from commodities. It's anywhere between 35 and 40%. And in some senses, there is that earnings risk that we actually hold.
So do you need to look at the material segment or metals very, very closely again?
In terms of downside?
Yeah.
Well, that's one sector that we remain a little cautious on. We have an underweight in that space because the predictability of that is clearly less, and B, the reasons for the predictability are beyond our control in some senses or our clear observation. So in that sense, that's where the risk lies.
But how much of that can be offset by some relief and margin pressures which were beginning to crop up because of commodity prices?
Margins tend to contribute small amounts and they tend to inch up. If the top line knocks itself off, then there tends to be more pressure.
So what are you going with in terms of Sensex earnings growth, EPS growth for this year and next year?
We are looking at about 24% into the current year.
2011?
2011, about 13% into the year thereafter.
13.
Yeah.
Why such a significant moderation?
Well, there has been a little bit of a bump up in the current year, so it tends to balance out a little bit. So effectively, you're looking at high double-digit growth over the next 2 years.
What about non-EPS factors which also drive stock prices like return ratios? Are we on a good wicket there?
That's our sense that beyond the earnings bit, because in some ways the best on the earnings has probably happened. You've had this upgrade cycle. It's tended to be a little flat over a period of time. And the most recent numbers would suggest that some of the revisions have tended to be on the downside. So I think that is one part of it, and probably the best has happened. But the other two parts, which is really in terms of the ROEs that these businesses are expected to generate, that's where the current year will be a low, and then you are actually likely to see a bump up. The same holds for free cash flows, which into the last year were actually negative, and our sense is over the next 3 years, you should see FCF yields actually move up meaningfully. Now, that's something that could change if the investment appetite changes. But in many ways, you're actually in that sweet spot where ROEs are looking to go up and FCFs are looking to go up. You don't want them going up too high, but it's a delta, it's a change in direction, which is what we're likely to see over the current year and into the next year.
So how long do you see this kind of benign trend lasting? Solid earnings growth, return on equity improving. Is it a 2-3 quarter phenomenon or much longer?
Well, I think a lot depends on if the micro can continue to hold and be reasonable and realistic, and you get a little bit of a push from the macro, which turns more to your favor. In that event, you'll hold at this level for 2 to 3 quarters at most. If that doesn't hold, it could take a while longer.